Hi, everyone. It's Rick Bensignor. Today is Tuesday, April 14th, and welcome to the In the Know Trader Show for this week. Well, markets are flying again, and the S&P is up some 52 points as I speak at 28.14. It's already gotten as high as 28.44. So we're seeing a little pullback here, but buyers are really in control these days. We've pushed through that 50% correction in the S&P, and we're still continuing higher. So markets are, or investors, better said, are kind of looking past some of the numbers we're seeing now. Here in New York, we are starting to finally plateau. And that's a good thing. But if you think of things in terms of, it probably took about 5 weeks of being indoors to get to the plateau mark, then depending upon how long we plateau and the curve actually starts going down, it could easily be another 5 weeks going forward before things in any way, shape, or form start getting back to normal. And I think that that phrase of getting back to normal is one that probably need to be altered anyway, because we're not sure what the new normal is going to look like. Hard to think that the economy and everyone kind of comes out of this unscathed. And I think as we go forward, we will see multiple changes in the way that people approach things. I suspect the handshake is virtually gone from common practice. I'm not saying nobody will shake hands, but I suspect it will be greatly reduced. And frankly, I can't tell you the next time I'm going to be comfortable sitting in a movie theater or being in a packed subway, etc. So a lot of this is still yet to be seen. In the Know Trader, as you know, is a newsletter that I started almost 2 years. In fact, it's just about 2 years ago. It was April of 2018. And I came up with this in order to give you, the individual investor, access to models that you would not have access to, and understand much more about how professional investors think about markets and where they trade. And the goal is to get you aligned with the direction and the positions that professional traders put on, as compared to many other people who write newsletters and talk about markets. I am now in my 40th year, almost starting my 41st year on the street. And it's all been on the institutional side, and therefore that's why this newsletter really gives you an edge on how to think about markets and how to align yourselves with what professionals are doing. So in order to get my key thoughts each week on the S&P and the bond market and gold market, as well as key support and resistance levels for those, and pretty much how institutions are looking at things, you can sign up for a subscription at intheknowtrader.com/sign-up-1.html. Not sure why that is the way it is, but that's what it is. When I go to my own website, go to the sign up tab, that's the web page that shows up. So I'm passing that on to you. You can certainly go to In the Know Trader to watch videos. In fact, I'm going to put up the video that yesterday Keller of StockCharts, and I had an interview that we had done at the Orlando Money Show back in February, and it's finally been produced and debuted yesterday. So I'll put that up on the website. And if you haven't had a chance to watch it yet, I think you'd want to. Dave really gets into asking me the questions about my process and come from and the experience I have and why we look at things differently than most other people in this industry. To contact me, it's rick@intheknowtrader.com. That is my email. Thank you for lots of emails that come in each week. After the shows are done, people asking questions, trying to inquire more, and thank you for all the nice comments that I get about how I do navigate the markets. Today's agenda, I thought for today what we would do is look at some of the most popularly traded ETFs. These are by volume, and I've excluded a few that we cover in the No Trader newsletter each week. So for instance, the spiders aren't there. And those are the most heavily traded by a factor of 20 to 1 over any other ETF. The volume they do daily is just massive compared to anything else. But of course, spiders track the S&P, and that information is in the newsletter each week. But here's a bunch of other ones that are very heavily traded. And again, they're done by volume, which doesn't necessarily mean they have the most assets or the biggest ETFs. Some of these could be low-priced ETFs, and therefore that's why they tend to do more volume. So obviously, a stock trading at 100 is going to do far less volume than a stock trading at 20. So this is a mixture, again, kind of based on volume. So we have EEM, which is emerging markets, the XLF, the financial spider. USO is the oil ETF that tracks the price of the commodity. GDX or gold names, we did those 2 weeks ago, and obviously gold's been flying. And we kind of told you our thoughts about that. VXX, this is a difficult one to trade because it's trading the VIX, but it's not outright trading the VIX. This is actually short. This is based on a short-term curve of the VIX curve. So buying VXX doesn't necessarily track with how the VIX moves each day. And I learned my lesson that years ago, where I thought I was essentially playing the VIX, but it's not exactly the same. So you need to kind of understand what that VXX is tracking if you're going to trade it. EFA is an ETF that covers Europe, Asia, and the Far East. That is a very big one. So basically, it's the developed world, not including North America. HYG is the high yield bond ETF. AMLP is the Alarian Master Limited Partnership. Again, you wouldn't think of that as being in one of the top ETFs, but again, because of price and how much energy names have gotten blasted, it actually becomes one of the more heavily traded ETFs. EWZ is ZIL, XLE is the energy spider, IAU is one of the more popular gold ETFs, similar to GLD. VEA is a Vanguard developed markets ETF. SLV is silver, XLU is the utility spider, XLK is the technology spider, and LQD is the investment grade bond ETF, and that has certainly gotten a lift after what Fed has come in to do. So that's what we're going to take a look at. Just quickly, before we get to the charts, we will take a look at just year to date how the S&P sectors are doing. Notice energy remains the dog. It's a heck of a lot better than it had been. It was down 50% relative to the S&P. It is only down about 28 to the S&P, but you look at these on a relative basis, and you see this year that we have a lot more compression than we had last year, where energy and healthcare got decimated relative to everything else. Here you've got a closer kind of towards the mean. Notice the best performing sector here is still technology, as it was last year. But it's only outperforming by a little over 800 basis points. You've got three very close together. Staples, healthcare, and utilities are in and around the 6.5% to 7% level. Financials, the other big loser, down 11.66% versus the S&P, and industrials down about 9.5%. So you've got, again, a huge loser relative to anything else. But when you look at the outperformers, they're much more stacked evenly this year than in prior years, and certainly last year. So you've got things more other than energy. You're really, you're closer to the zero line in most other things. But look, if you're in financials, you're still trailing by 1,100 or almost 1,200 basis points. It's still been a hard hit. thing today. Banks started on the upside, and many of them just, I noticed before I started recording, have gone negative on the day. So banks are still feeling pressure given everything that's going on. So even in a big up market like we're seeing today, you don't always get the performance that you'd expect. And that's why it's so important um, to keep track of the different sectors of the market, and especially if you can figure out how to play the sectors you have and when to play outperformers and underperformers, you have the best chance of outperforming the market in general. So just something I'd mentioned probably a little over a month ago, and just with everything going on with the virus and things, I'm a little delayed in coming out with, I still will tell you that shortly I will come out with a new piece that you can subscribe to that will focus solely on the 11 sectors of the S&P, and what our goal will be is to get you in at least a half dozen of them, and essentially walk away from and not have exposure in the other ones. And to me, just think of it conceptually. If you can pick the best 6 performing sectors in the S&P, then very good chances are you're going to outperform the S&P. If you put your money and you allocate it to those 6 sectors, you're going to do better than if you had been in spiders alone. So that's, I will keep you informed as that comes out, and we'll do a little marketing campaign around it. But that is something new that I think could be extremely helpful for those of you who are not looking to trade constantly, but do want to have a chance of actually outperforming the markets. So that is coming soon. Let's get to our charts, and we're going to start with, as I said, the EEM. All right, so the emerging market ETF. There are lots of them, but this is them. We take a look at this. We look at how many of these downside exhaustion signals lined up with lows going back into 2018 and the early part of 2019. So remember, we use institutional models. This is one of the many ones we use, and this is called sequential. There's an aggressive sequential downside exhaustion count here. Market went straight up. Another one here. Market went up for months. And the third one came on the bottom in the summer of 2019, leading to the highs that we had going into January. Then, of course, this fell apart. Notice we bottomed on a setup 9. This is often a potential turning point, and we've gotten a major bounce. Now, we're not up at a 50% retracement yet. So if you take a look at 38 and about roughly 38.20, this orange line would represent a 50% retracement. It's part of the cloud model, but I know as of right now, it also happens to be the 50% retracement. So I suspect that EM still has a chance to kind of get into this range here, slightly higher in the 37.25 to 38.25 level. In fact, it may even extend up to 38.84, which is the propulsion exhaustion signal. And then you've got the test of the major breakdown level. So anything here over the next couple dollars higher potentially represents some significant resistance. And if you're in the name, and if you've been in the name, let's say you've been in this name for years, and you can kind of see, well, heck, this has been sideways. And it's made, on percentage basis, it's had some really big moves from obviously the bottom in 16. We made a minimal new high in 2018, but you essentially have a double top here. This purple line it just drew against old highs. And now we've come down and we've held against the 2016 low. So you're kind of in a range. So as you get back towards the middle of the range, it may not be the worst thing to take some money off, simply thinking in terms of, is my money best used in this space, or is there a better place that I can make more consistent money? And certainly, just as an example, if you'd have been in the U.S. markets, not the emerging markets, you had obviously done much better over time, because up until February, the S&P was on all-time highs, and emerging markets aren't even close. again, as you come back, towards the mid-range here, it's probably not a bad thing to just think in terms of that there's better places to be. It doesn't mean I go to zero exposure in emerging markets, but I certainly take some exposure down. Let's take a look at XLF here. Now, financials again took out the 2016 high late last year, early part of this year, and then they collapse. And now we are getting back towards a 50% retracement here. Obviously, the S&P has scooted through and above its 50% retracement level. Financials are underperformers, and they haven't reached there yet too. And I would kind of think in the same terms, this doesn't look so dissimilar to actually the emerging markets chart in the sense that the low that we just made was above the prior low. And we also had like kind of the minimal new high before things fell apart. So same type thing here. Financials are going to have resistance anywhere in the mid to upper 20s in the XLF, and same type thing, may not be the worst, idea to just lighten some exposure when and if this rallies up there, simply because this too has not performed like some other ones have. And, to me, I own a fair amount of XLF myself. I would think about that if we got north of 26, I'd probably do some selling between, the cloud. Now the cloud shoots up, but anything in the mid to upper 20s, I'd be a seller. If I have to put it back on above all-time highs, that would be great. Nothing I'd love to do more than actually be forced to put on more exposure above all-time highs. That would make me happy. Let's take a look at USO. This is the oil ETF, and because of how oil is traded, we're going to have to. Oops. Let's see. Just trying to manipulate the chart here. So this again tracks kind of the front month futures, and it does roll before the front month futures roll, so it doesn't get gamed. But you can see the price of oil is essentially a disaster. As far as investment opportunity for us as a consumer, the price of oil being down in the low 20s is terrific because we're paying, virtually, I suspect, everywhere in the country, it's got to be under $2 a barrel for basic unleaded. So think of that almost as a tax break. Is it investable? I'd say it's given the structure of the oil market right now, I'm not touching this for not even as a long-term investment, not yet. I think oil might very well still go lower. GDX, we talked about this again 2 weeks ago. Gold stocks are ripping. The low in gold was made right here a few weeks ago, and the same thing happened with GDX. Gold got down to $14.50 an ounce. It's now near 1800-ish, certainly in the high 17s. And these are ripping. The only thing here, so you've got some old highs from 2016, right around just beneath 32, basically where we are now. And in theory, if we got above there, we would rip to the upside. But also notice here, I'll blow this up a bit. This week happens to be a weekly 12. So next week could easily be a 13, which means we may be exhausting ourselves. So I don't want to put on new exposure on this breakout until we properly get above 33.5. So this is the type of thing. I am a buyer on pullbacks, and I do like gold for the long term. And I think it's only a matter of time that, let me just condense this down here. So if you look at how far off the all-time highs GDX is, I do think gold has a real opportunity here to keep going higher, and therefore, timing of entry is important. I bought some of this down in here, or actually, I didn't buy GDX. I bought GLD for myself, so I did buy gold down into this sell-off. But this is the type of thing that I like this rounding bottom. I like the fact that this move down likely took out a lot of longs just before it turned right around and came back up. So I like this, and I suspect that gold can get up to 40. Think about here, where it broke down from, somewhere around here, way back in 2010 and 2012. right? So we had one last low here, we went higher, and then once it broke, it never came back. So gold names have the chance to really have a decent percent increase. It's just it's going to be a little trickier here than it just was even a week ago. So I'm a buyer in a pullback. VXX, again, this is a tricky one. It's not quite the VIX the way you think. So this has to do with the VIX curve, and I'd say if you're going to go after it, I probably actually I'd probably do a little bit of buying inside this weekly cloud. Besides that, though, I'm going to tell you, this is not a name to play unless you really know what you're doing and understand this product. It's not trading the VIX. So if you look at the VIX on TV, this can go in the opposite direction of the VIX, which won't make sense to most of you. So I'm actually going to tell you, don't trade it. Well, I'm just going to skip over it. Here's the EFA. Again, this is the Europe, Far East, and Asia ETF. Bottomed on a weekly 9 count, making its way higher. I could easily see it getting up to 59 and change here, the propulsion target. Think about where the breakdown came, and I would say, let's see, we look at this. I mean, you could get all the way back up, even as high as 67. So here, if you think the market's going to hold, if it pulls back towards 49, you're a buyer against this level here. Last time we went against bearish propulsion levels, it held, so it never turned bearish. That's now moved up to 49.04. So if the market gives you a chance down around there, I'd probably be a buyer. And that's making the assumption, and again, it's an assumption, it's not a fact, that the lows that we saw in March are not going to get taken out. But we certainly can be in trading ranges for quite some time. There's nothing that says, there are people out there saying we're going to just zoom to new all-time highs. This obviously had a huge breakdown. This is the high yield. It's like the junk bond market. And this got trashed on the way down, and then got a super lift last week as the Fed said that they'd essentially be a buyer virtually. Well, certainly investment grade bonds, and this is junk stuff, but it helped lift this higher. So now we kind of ran out of steam on the upside against the cloud. You're going to see there's certainly trap buyers from before. So this should settle in, not likely get much higher than the top of the cloud. If you go into the camp of don't fight the Fed, then if this pulls back to 79 to about 78-ish, kind of right in here, then you'd be a buyer, assuming, and again, these are big assumptions that are not facts, that the lows we saw are not going to get taken out. If you're a tremendous bear and you think things are going to get much worse and that, this is nothing more than a dead cat bounce, then you would not be a buyer here, because your assumption is going to be that we're going to take out these March lows. I'm not in that camp. I think that barring virus cases ticking up in Europe, which is ahead of us, so I kind of like to watch what's going on in Europe, because it gives us some clue of what might very well go on here in the US. Then I'm using that as kind of my forecasting machine or methodology. And as long as we don't see an uptick there, then I would think the March lows hold. But I also think we're going to run out of steam and spend time, whether it's this or any other market. We're not going to take out the highs from at near 3,400 in the S&P. We're also not going to take out the lows we saw in March in the S&P. So we stay in between. So I've got to play ranges, and right now it's not about being a long-term investor. It's about being a medium-term trader and selling strength and buying weakness. That's the way I'm thinking about going forward. AMLP. So again, this is a master limited partnership. This relates to the energy space. So you can see when we bring this in, it looks a heck of a lot, or even worse than the oil market. Has had a recent bounce here. Possibly this low was the low, but again, in this energy space, I'm not too fond of really investing in this. Now, is it possible that this $4 stock gets up to $8 or $9? It is, and that would be, a home run in percentage terms. But the trends are all down. If I throw on, well, the 200s all the way up there, the 50-week moving average would be much lower. You've got pieces of the cloud. So notice that the last rally came off of a 9, stopped at the cloud's baseline, and got totally broke apart. So right now, could you get from 4 to 567? Yeah, it's over 25% return. Is it worth doing it? I can't tell you it is. Again, better places to play than this. EWZ is Brazil. Brazil, similar look, 13 on the top, 9 on the bottom. I think that's a good low. Now, remember, this is more in the emerging market space. It is technically weaker than, your standard U.S. market. Potential resistance could start at 29 and change, but my guess is this could virtually fill the gap and go as high as 24. So on pullbacks, you could be a buyer here. And again, I'll assume that this low from March is going to hold. XLE is going to be fairly disastrous looking, other than the recent bounce. This is the energy space, same type of thing. Worst performer over the last 20 years in the S&P. In fact, if you've been long this, you are down money. This is the only part of the market that you are actually down over the last 20 years. IAU, gold. Here we go. Exhaustion of trend, got a good sell-off, went right to the TDST line at top of the cloud. That's why I bought myself gold down there. This is now making new highs. Upside targets are higher at 1727 and just over 19. I'm staying with my gold for now. VEA. Again, this is developed markets, bottoming on a weekly 9, moving up, similar to many other charts we've looked at. Going to be resistance up here, buy on pullbacks. Silver, SLV, hit a propulsion, the full propulsion exhaustion level on the lows, didn't have a count or anything with it. Notice it did have a weekly 13 on the high, or week before the high, and then it fell apart. It's come back. It's recouped half. I'd say for now, if you're a silver trader, this really needs to get through 1610 on multiple Friday closes to have a chance for this to break out to the upside like gold has. This is clearly gold's poor brother. And we still had a few to go, but we are out of time this week. I thank you for tuning in, and stay calm in these markets. Lots of opportunities for those who know how to navigate markets. I'm Rick Bensignor, and this has been In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.